Good morning. Guten Morgen. Yeah, I know I'm supposed to start, but I just heard my coffee maker go beep, 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 beep. Let me go get a cup of love. BRB. It's Friday, which means my coffee cups are small. I've drank out of all the big ones. And the dishwasher gets run on Friday afternoon. So happy Wash Day. Happy what do you call it? Jackson Hole Day. I'm down in a hole. Yeah. So yeah, Jackson Hole Day. This used to be a thing. Oh, back when I was knee high to a grasshopper. And then I don't know, about 10 or 12 years ago, it turned into kind of like a secretive conference amongst global central bankers into a photo opportunity. So somebody came along, or some group of people came along and kind of just screwed it all up and turned it into a press conference. And they started doing things like faking poses, um or whatever. It just became a media event. So I don't know, I think less of it than before. I mean, it used to be where they would plan and strategize as, all the central bankers around the world, and I'm like, oh man, that's cool. Now it's a photo op. It's a if you're it's an Instagram post. So um everybody's upset and concerned and worried and excited about the speech today by Chairman Warsh, and he's already told you he's not going to say anything. So people are going to be disappointed. Uh, well, all right. All right. But that's okay. We don't care. Our job is to analyze the data. We track market sentiment. So, how the market responds, how the market feels about Warsh and the speech and the Strait of Hormuz and the Treasury intervention and just anything we can track quantitatively. Sentiment, fundamentals, technicals, so on and so forth. So it doesn't, right? It doesn't frighten us. Japan released a CPI, came out lower than 2%. Oh, what? Remember, they're trying to create inflation. Isn't it funny? Funny how? They've been trying for 30 years. France managed to narrowly avoid recession by lying on their second quarter GDP figures. Oh, good job. I don't know about the lying part, but you know, I find it really interesting where, you know, the government reports all the all the activity in their economy, all of it. When you go to 7-Eleven and buy a Slurpee, it gets added to GDP. So when you think of it, every transaction throughout the entire period, from every business, every person, just everything, all activity. And they report it, let's say 1.9 versus 2.0. What? I mean, seriously? They have that level of accuracy? So whatever the French numbers were, it's like, oh, good. Thank goodness we just narrowly avoided recession. Narrowly? You're that good? Your margin of error? You're like, woo, that was close. No, no, no. I don't think the numbers are even that close. I mean, numbers are numbers for sure. But really, I mean, Tokyo CPI is difficult enough, but take a country's GDP, really? Okay, well, that's good. Thank goodness France is not in a recession. Yeah. Thank goodness, everybody. Australian dollars hitting 3-month highs as traders wait for a major speech by Fed chair. Yep. We're also keeping an eye on Canada, which reports its horrible GDP figures at 12:30. Is that right? It comes out that late? Really? Cool. Well, all I can tell you is everything is right as rain. As long as Nvidia that's how sensitive this market is, huh? As long as Nvidia is making money, we're happy. Yeah. So my concern, and I won't go into it today because I spent a lot of time yesterday. See, I do a New York time. I do a morning um, interaction with you like we're doing now, and I do an afternoon one inside of the platform. And so yesterday I was talking about the mathematical probability of, even though everything is awesome right now, everything is awesome. Um, the potential for the house of cards to come crashing down, like soon, like real soon. Will it happen? That I don't know. I'm not a genie in a bottle. I know I look like one. Yeah. I got moves like Jagga. But I don't know the future. But we do have quantitative data to help us analyze probabilities of up, down, or sideways. Now, past performance is not indicative of future results. Yeah, for sure. This year is different. Today is different. It's never happened before. Tomorrow may never arrive. Yesterday is a faint memory, except we have recorded everything that happened yesterday data wise and put it in the database. And we have 20 years of recording such data. Good. So we do see trends and patterns inside the chaos. That's all chaos theory is. You take all data and it just looks like a gobbledygoo mess. And inside of that, we find reliable, repeatable patterns. That's what chaos theory is. So we're using chaos theory to take all economic data for all major economies around the world going back 20 years. Like, dude, it's crazy, right? And well, look, we're counting the cards. So we're good poker players. We know the game. We know the right strategy at the right time. What do you do if you get a jack? What do you do when you do get a 3-8 versus a 3-9 or a 3-7? Do you have different strategies for this? Yeah, probably. What if you got two diamonds or two clubs in your hand? Well, wait for the flop. Ooh, two more on the yeah. So anyways, you know how to play the game. We call that technical analysis, right? You know, technically. You're technically proficient in the game of foreign exchange, or the stock market, or the treasury market, or the commodities market. We track all of this. You know how to play the game. But the next edge is if you're proficient at counting the cards. What's the likelihood there's another face card? How many cards are left in the deck? And then you want to start reading the other players at the table. How often do they look at their cards? Do they every time it's their turn, they look down at the cards. Why? Because they forgot they had ace, ace. No, they got junk hands, and they're like, "What is it again?" Right? And then how do they bet? So now you're reading the market. So we're reading sentiment. We're reading institutional betting, if you want to call it that. Okay. Okay. And we're like, okay, okay. So I think I've run the analogy out, but there's a lot going on here. And one of the potential outcomes of the next, I'll say 10 days, is that all this joyousness, see, this number represents joy. Bitcoin at 80, isn't that good? Gold climbing, not really. Oil stabilizing. Yeah, 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 yeah. Dollars, well, it's no weaker than it was, but it's no stronger than it was. Will that change? How come we've been at 99 for a week and a half? Is this going to suddenly go to 102? Wouldn't you like to know or have a sense of the probability? Is this going to go to 96 or 103? What's next? Let me say it this way. Today is dead. Let me say it differently. August is over. You're like, Wayne, we got a lot of time. No, we're not. No, it's over. The month of August is over. If you're not thinking September, you're behind. Mm. You need to be setting up September. And then, if that occurs, you're not going to be surprised. And then, as that's happening, as we get into September, I'm very, very, very quickly, let's say by the time we're halfway through September, I'm already going to start being aggressive in trading for October. What? Yeah. So we're always going to be 2 weeks in advance. So right now, I'm just telling you, in the next 10 days, it could be today, it could be Monday, it could be right at the end of next week. This lovely, lovely 7 on the risk radar could just suddenly, seemingly without warning, boom, turn -7. Is this important information? Well, we don't know if it's going to happen, do we? Right? We don't know. And you might be thinking, Wayne, is this the war in Iran? Is it the war in the Ukraine? Is this Warsh? Is this Besant? Is this Trump? All that kind of stuff. I'm like, those are also risk factors that I'm not even counting. Holy smokes. So, how do we handle it now? Don't be shocked. In fact, be ready. Be ready for it to maybe happen. Go ahead, go about your day. Go ahead, make your money right now. The market is what it is. If things are bullish and you got a dip, you buy a dip. If the market's bullish and somewhere else, you buy a dip. If the market is bearish somewhere else, you sell a rip. And ideally, they're all correlated and all make sense to you. And you're not guessing. You're not worried about the future. You're just aware of the potential change, the probable change. You're aware of the likelihood of another face card coming up. Okay. If you have two kings and you need an ace, how many aces are left? How many have you seen? Okay. So you don't know if you'll get it, but you just have a good sense that there's we've gone through more than half of the deck, but no aces have come up that you know of. So you're like, you know what? Yeah, we're down to 1/3 of the deck, and you think there's four aces still in there. Changes the probability of you getting an ace. So your probability here is, hey, the game could change. Everything is right as rain, and this could turn to, well, let's be extreme, to very, very nice risk on. Hey, good job, NVIDIA, to just bloodbath. Now, I'm not an extreme guy. I don't think anything does that. Okay. Like the probability of it just turning bloodbath to me is nearly zero. They do happen. Things do happen to put you in that situation, but I'm not afraid of them because they're extraordinarily unlikely. Now, my family, when we're in the backyard swimming in the pool or drinking champagne in the hot tub, yeah, if there's lightning, and not even lightning you see, just lightning on our phone goes bzzz, lightning, 20 miles away, you're like out of the pool. The odds of dying have changed. You can't even see it. Well, you would be able to see 20 miles away, but let's just say you don't see it. But the phone, bzzz, because we have an app, right, and says, "Oh, well, there was a lightning strike nearby." All right, out of the pool, everything has just changed. You can't see it, but we have the data, and the data suggests the likelihood of dying in the pool has increased. All right, well, I can't afford death. It's a price I'm not willing to risk, even if it's low. The fact that it's higher, I adjust. So what we have here is failure to communicate. No, what we have here is a similar warning. There might be a storm, 4 days out. I like to show NOAA in this one, right? National Hurricane Center. NOAA. Okay, look. By the way, Dolly Parton died like 3 days ago, and they're like, "Oh my God, there's a tropical storm coming named Dolly." Do you know the first year that they ever named a storm Dolly was the year Dolly Parton was born? You got to know these things. You didn't care 9 years ago, but now you care. So, anyways, this is actually good. This is actually a perfect place, actually, for me to let me change gears here because this is good. Because I like using this data. Um, so I've been using this website for 20 years, and luckily, because it's government owned, it's never it's never changed. Oh my God. Can you imagine? You're like, let me check MySpace. let me see what's going on MySpace. Can you imagine this hasn't changed? All right. But anyways, um, if we can't see this, right? This, I'm located right here. All right. I can't see this storm. but I do have the data. I have the satellite imagery, and I'm like, all right, should I change my behavior? Yes, because you have knowledge. Huh? You're not smart, just smart and beautiful, but you can act upon your knowledge. Cool. And so you can see from outer space, you could probably utilize it. Okay, we want to see if Dolly is moving this way or that way in the next few days. Yeah. And we don't need by much. See, it's moving this way. This is all we know right now. Okay. And we don't know where it's going to go. But where it goes, it matters. So what I'm looking at is the islands. Hey, what's up, Nevis? Nevis is right there. What's up, Nevis? Yeah, right there is the ECCB. Yeah, Eastern Caribbean Central Bank. Yeah. All right. So, why does this matter and how does it change the game? If it comes this way and these islands force it above the north side, guess what? Frozen concentrated orange juice. Home Depot, Lowe's. Yeah. These are the things that you need to start watching and maybe even buying as soon as you know, because this gets updated a lot. And if you see Dolly kind of floating a little bit north, okay, just above, okay, the Dominican Republic and Haiti, just above Cuba, then you get this situation that just kind of cruises. Okay, it's going to go like this. Which is interesting because Warsh, I think next weekend needs to be here. Wouldn't that be interesting? But anyways, la di da di da. If it comes in a little lower, Jamaica, Jamaican me crazy, huh? The Caymans. What happens? What do you buy? Oil is the primary. Okay. If it comes in too north, okay. And then, of course, it'll just fizzle out. What's up, Bermuda? Okay. Then nothing. Cool, right? See, you have the data and you can act upon it, and you have the ability to see and change assets. Are you going to buy Home Depot and Lowe's stock? Are you going to buy frozen concentrated orange juice futures? Or are you going to buy WTI? Okay. From here to here, actually, I should probably, Mexico's got a few. From, okay. There's a lot of oil right here. Thousands of rigs. Yeah. Permian Basin's over here. Okay. But we're talking about oil rigs. And by the way, it doesn't have to hit. What it has to do is come in low and then the fear of it hitting. But if it comes in this low, I mean, what sometimes happens, and you have to understand weather if you're going to trade weather, but what'll happen is if it comes in too low, it's going to hit these mountains. See, this is all mountains. Mexico, you might think is mostly desert, but it's mostly mountains. And most people in Mexico live right here. 80% of Mexico lives right there. Um, yeah. So if you think of like all of this as being mountains and the hurricane comes in too low, it gets caught up, hung up on the mountains. The mountains tear apart the storm, cooling off cooling it off rapidly, and that turns it into rain, right? By changing the dew point. And it just gets stuck here and it'll just circle and die. And there'll be a lot of flooding and all that kind of stuff in here. And of course, Cayman Islands and Jamaica and Cuba, they're not going to be happy about a storm just sitting here. Um, but that's what happens. But if it just comes in a little bit, like if it hits Jamaica, it's going to turn north, and this is all oil. So it's at the point in which CNN decides to cover this, in which you should already be buying WTI and trading the premia for potential maybe supply shock. It doesn't actually have to hit, but if it does and it's big enough and it's a direct hit, what happens is there's right thousands of these oil rigs, and um, they send out helicopters, pick the boys up. There's women out there, but pick the men and women up and um, bring them back to shore. But they have to shut down the well and put safety measures in there and shore that all up. And so even if it's just a threat, what matters the most to WTI that it's reported, let's say Exxon is um, shuttering their wells in anticipation of a hit by the hurricane. Whoa, that's next level. The first part is the fear that it happens, but if it does happen, there's more premium added to the price. It's it's the threat to supply, and then shutting down and restarting these things. It's not flipping a switch, and it probably takes a couple of days, right? But so sending people away, okay, well, shutting down takes a couple of days, and then they send people to the offshore. Hurricane has to come and go, and then you got to send people out there, and a couple more days. So you lose, let's say, assuming there's no major damage, you're going to lose a week and a half of oil, but the oil prices will jump because that is a threat. Yeah, and if oil supplies are already low, which is now a little sprinkling of our this year versus most years, we're already low, so a threat to oil supply by Hurricane Dolly would push us to $100 a barrel. Wouldn't you like to know? Yeah. Well, this is what we're talking about. So you're reading the hands of players, so to speak. Okay? This way, this way, and this way, and this way, okay? All matter. Okay? You're not going to trade the financial market here, you're not going to trade the financial market here. The assets you trade here are different from the assets you trade there. It's kind of neat, right? Let me show you. Yeah. oddly enough, I'm Google Global. Look at this image. Look at this. I don't have any gray hair. Look what's behind me. Just doing a webinar. Huh? I believe this is a map of Texas and Louisiana, but I don't need to be watching this because I can see the hurricane that I'm tracking in the background. It's not even the point of this webinar. If I remember, this had to do with the changing of the farm bill and leverage in the United States dropping from 100 to 1 to 50 to 1 but it was in a farm bill. Yeah, because it has to do with futures and the National Futures Association and everything. So, but anyway, so I was talking about that, like, hey, America, stop freaking out. Oh my God, I can't have 100 to 1 leverage. You don't need 100 to 1 leverage. That's what that was about. And it just so happens I'm tracking this hurricane, and I can tell you, like, maybe I should be front running some Home Depot stock, but that's a big fat giant maybe. You can see it's north enough where it'll probably turn out to see. Cool. Well, my point is, I have nothing but gray hair. Here, I have no gray hair. And this is how I've been trading through that period. Isn't that wild? Yeah, it's weird to Google yourself, huh? Wow, that's a long time ago. Cool. Do 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 do. What do you guys think? Are you happy? You're like, oh my God, this is so good. Yeah. While the market waits for Warsh.
Platinum. Bullish bias holds as breakout test.
XRP pullback tests 1 bar 40. Support amid Ripple Prime product suite expansion.
British pound month-end rebalancing and UK policy mix. BNY. Wall Street might open broadly lower. Swiss KOF leading indicator strongest since November 2021. US dollar. Dovish Fed repricing risk grows. BBH.
Oil holds steady, on track for weekly fall on U.S.-Iran talks stalemate. Canadian dollar rises against majors.
Federal Reserve. Markets eye wash signals. Rabobank.
Turkey trade gap widens in July. Platinum. Bullish bias holds as breakout test looms. OCBC.
By the way, yesterday in the afternoon webinar, I covered platinum and palladium. Why? Because I can. Now, this NFP revision also can be very important. This is very, 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 very interesting. And if anything occurs in the war speech, it would be interesting if he addressed this. It's probably too soon, right? Like, it's too close to the meeting. But this revision can be very, very, very important. Whoa. So, for example, what if the Fed, what if this Bureau of Labor Statistics revision suggests the unemployment rate in the United States is higher than we thought? The Fed can't raise interest rates, even if it wanted to. Does that matter? Oh, yeah. Yeah. If you want mortgage rates to stabilize, oh, yeah. If you want the bond market to stabilize, oh, yeah. So we spent a lot of time on silver, gold, platinum, palladium yesterday, and gold is up 1, silver's up 2.5. Yeah, yeah, yeah. Gotcha. Boo-doo-doo. Let me hang on. I wanted to do this. I want to ask Aiden about this. Hang on. Hang on. Hang on. Hang on. Hang on. All right. Daddy's done. Yeah. So the smart move, the smart money might be watching this more than Jackson Hole, because like I said, Jackson Hole is turned into a media event. So the media is publicizing it like crazy, but in reality, he's not going to say anything. They're going to ask for his reaction function. So let's play a game. Every time the word reaction function is mentioned, you have to do a shot of tequila. What do you think of that? But I think the real news, like I said, the real news here is the revision to NFP numbers and the potential impact on the unemployment rate. Yeah. Anything else? You, Mitch? Not a big deal. It's the inflation expectations that matter, but we track 5-year forwards and stuff. Like we analyze this. You don't have to get it from here. But I'm going to kill that. I'm going to kill that. Chicago PMI, kill it. You, Mitch, consumer sentiment, couldn't care less how you feel. I care about what you're going to do. Speech, 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 speech. Mm, 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 mm. Mm, 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 mm. Zoomed here, right? Yeah. What can I learn from the gold silver ratio? Oh, I have to sign in. I am signed in, you stupid. There we go. The gold silver ratio is a distraction. What? I focus on individual and convection correlation. Oh, that's interesting. He hasn't updated the pipeline, right? This is interesting. Let's see if this is the right AI. It's a long story. I don't want to get into it right now about which AI it is. It's kind of interesting. But let me ask it. You report the this ratio on the gold radar. Why? How do I use it? That's poor English, but there's a conversation. Okay, it serves as a secondary confirmation of liquidity flows, not a primary signal. We use it to identify when precious metals are decoupling from their underlying macro correlations. But my conviction is always anchored in institutional positioning. All right, that sounds good. Okay, the market remains in a strong risk on environment. Score 7.02. So it's changed in the last few minutes. As institutional capital aggressively rotates into equities, ignoring the rise in the 10-year yield. Yeah, because of NVIDIA, right? Complacency is firmly entrenched with the VIX at 14.43. See, he just looked at everything in real time. And a consistent daily decline, signaling an exit from protective positioning. What does this mean? Institutional investors are reducing their hedges. Yeah. Now I'm looking forward and thinking they're going to add hedging. But I think maybe, but anyways, I don't have to get into that. Let's go back to what he's saying here. Why? The yield in the 10-year is climbing. Okay. The equity markets are ignoring this pressure, confirming it's a growth over rates regime. The VIX at 14.43 combined with a negative 5.13%, right, on the VIX move confirms that speculative shorts are being aggressively covered. WTI is trending lower, contradicting the geopolitical risk narrative often used to justify oil spikes. The market is fundamentally choosing beta over energy hedges. So the risk premium of the Iran war is diminishing. Dixie at 99.2, showing limited movement despite rising yields. The lack of a strong USD response suggests the current move is driven by equity specific appetite rather than broad based flight to safety. Yes. It's creepy, right? Because, this is all the stuff I've been saying, but I didn't tell it to say this. I only taught it how to trade. Okay. USD. We're currently, S&P 500. We're currently at 77.30. Okay. Long at 77, target 78.50, stop at 76.50. Wait, what? Yeah, totally. WTI, he's short at 83.20, targeting 80.50. Well, I know that that's a double bottom, so that makes sense to me. And we're going to, right? The stop is at 84.50. Bitcoin currently at 79,500. Okay. Long at 78,500, target 82,000, stop at 77. Trend following, risk on play. So he's buying a dip. Catalyst window, immediate focus. Any move in the 10-year beyond 4.72 that fails to break equity momentum will be the ultimate confirmation of buy the dip structural bias. All right, you guys use this, right? I mean, you're talking to Aiden here. All I did was ask him about the gold silver ratio. It's not a bad thing, right? Yeah. Yeah, so I noticed the comments about Claudia Sam. Yeah, she's the one that said to the government, just give people free money. Okay? Just give people free money during COVID. She didn't understand that that is guaranteed poverty and guaranteed inflation. In fact, it's the only way to do it. You understand? The only way to get this persistent high inflation is to have done what she recommended. And then, of course, the government did it. And so we get this situation of persistent inflation. And even if the rate of inflation is dropping from 3 closer to 2, doesn't mean prices have come down. It means they're going up less fast. So because of Claudia Sam, everything in your life is 30 to 50% more expensive. It came from her advice. An economist should know this. You give money away for free with no productivity attached to it. There's no return on investment. It creates inflation. It just inflates everything. Everybody won the lottery. I'm not even joking. I think I got like 10 grand. My family got 10 grand. I didn't even know why. It was weird. Like, it's a lot of money, guys. It's like winning the lottery. I got $10,000 and I didn't do anything with it. No, what I did is I gave it to people that needed it. So, but the consequence of giving money away to everybody without any sort of return on the investment, that creates inflation. An economist should know that. In fact, the only way, according to Milton Friedman, to create this type of inflation is through increasing the money supply. It's a monetary issue. And she said, give money away for free. And, well, the logical conclusion to that is high inflation. So now she says, raise interest rates. What's the logical conclusion of that? High unemployment. So what happens 5 years from now if the Fed jacked up interest rates, let's say 1% over time? So, guess what happens? You have high inflation because raising interest rates will not fix the fact that there's too much money in the economy. So we would have still high inflation, but then we would have high employment. We would fall into stagflation. I don't like Claudia Somm. Jacking up interest rates now would create stagflation. And I told you 5 years ago when this was happening, what the outcome was going to be, even in the midst of COVID. But does anyone remember? I said five years ago or 6 years ago, whenever it was, the way to solve the problem. It's not the Fed raising interest rates. It would only create stagflation. So you're fired, Claudia Somm. But what is the solution? Put me in charge, coach. I'm ready to play. What is the solution? Type in a question mark if you don't know. Let me know you care. If you don't care about this, if you just want to look at a euro dollar chart, even though it's probably the dumbest thing to be doing right now. Do you want to know how the world should work or how that world actually works? Yeah, yesterday I even taught in our afternoon webinar how hedge funds are going to play the next 10 days with the potential for pump and dumps and stuff. But anyways, lower rates and pull money out of the system. Well, lower rates only if unemployment goes low, but then that creates more inflation and all that. So no, it's not monetary policy. So step back and say the Fed can't solve this problem. The Fed didn't create the problem, so why would the Fed be able to solve the problem? Yeah. It's not a Fed problem. The Fed didn't cause it. What did the Fed do at that time? The Fed did quantitative easing. Now, it's very debatable whether that works, but here's the thing. Quantitative easing is the Fed buying seasoned treasuries. The Treasury's doing it right now, but it was the Fed. Now, the interesting thing about the Fed is the Fed doesn't put money out, Fed puts credit out. But anyways, if the Fed buys a whole bunch of 30-year bonds, they can sell those bonds in the future. So they can add credit and liquidity to the economy by buying bonds. So they remove the bonds and treasuries, and they even bought mortgages. They can buy all these assets and put the money into the economy. Okay, that is inflationary. But what can they do? Let's say 5 years go by, the economy recovers. They can sell those treasuries. They can sell those bonds. They can sell those mortgages and give a good deal. So people buy it. There's no doubt. And they buy it from the Fed, and the Fed removes the money. Problem solved. Now, what's going on? How do we solve this? Because the Fed has been doing that. Now, they stopped selling treasuries recently. It's part of our situation. But the long and persistent, Okay. Now, think about what we were talking about. Claudia Sahm. Who was she advising? The Fed? No, she doesn't work at the Fed anymore. They got rid of her. So who was she advising when she said, give money away for free? And give it to everybody, people that need the money and people that don't need the money. Well, Jim, you're not wrong, because every citizen of age is a voter, but there's a connotation to the word, meaning it was political. No, I'm not going there. That we're talking about economics. And by the way, I think both the Democrats, yeah, well, I know the Democrats and the Republicans both fell for this bad advice. But maybe things were just so desperate, we were willing to take on the risk of the consequence. But whatever, we still have prices 30, 40, 50% higher than they used to, which means, by the way, you are more poor now than you were 8 years ago. And it's specifically because of Claudia Sam's advice. Crazy, isn't it? And I said it at the time, everybody's going to lose, especially poor people. The biggest winners, I told you, were going to be the billionaires. And it all happened. It's just economics. So what happened, guys, is the federal government either created money or borrowed money. It's really borrowed. Okay? They borrowed money and put the money into the economy and gave that money away for free. So we have debt, and the money just went into the economy, just like that. So now the United States has a very, 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 very high credit card debt, and they spent all the money at restaurants and bars. So once you got drunk on your free money, and once you got fattened up on your free money, 3 days later, you're thirsty and hungry again, but you can't afford to buy any more because you burned through the credit and you have this massive debt. That's exactly what has happened. And when I say bars and restaurants, that is the number one thing. The COVID stimulus, I'm talking about stimulus. The COVID stimulus, the number one use was bars and restaurants. Okay. And, you know, if you gave rich people money, you know what they do with it? They invest it. That's why they're rich. That's why they're wealthy. So here's the situation. The debt in the United States skyrocketed because of COVID. Claudia Sahm told the government, borrow like trillions, $5 trillion, and just give it away for free. Everybody in the United States won the lottery. Holy crap. You think, right? You think that's going to be inflationary? It's the definition of inflationary. Oh, you go international, Zachary. Treasuries. They just issue treasuries. Yeah. Now, the other way to do it is just print money. You can literally just print the money. Okay. All right. So let's get back to the solution. How do we solve the situation? If the Fed can't solve it by raising interest rates, because interest rates would just raising interest rates further would only it wouldn't impact inflation because it doesn't solve the problem. It doesn't even address the problem. So raising interest rates is really quite dumb. And I'm surprised by how many people think that that's the solution. It's just dumb. All right. So if they did raise interest rates, it won't impact inflation because it doesn't address the problem. So then what? It would increase unemployment because it increased the cost of doing business in the United States, which means businesses will struggle to be profitable, which means they'll cut back on spending, they'll cut back in employment, and if things are really bad, they'll have to actually lay people off. All right, so now we have stagflation. Yeah, not cool. So it's not a Fed issue. The Fed put money, by the way, the Fed also put in 5 trillion because the Fed and the government, the central bank and the central government were not talking to each other. It was very mismanaged. It was very, very poor. Very, very poorly done. So while the government was putting $5 trillion in, because it was in their mind, do as much as you can, as fast as you can, because the world is ending. Meanwhile, the Fed is like, do as much as you can and as much, as fast as you can, because the world is ending. And they forgot to coordinate with each other. So they could have done 2.5 trillion each. But the Fed also did 5 trillion. But the Fed has removed at least 2 trillion of that money. So now we're somewhere around 7.5 to 8 trillion. Too much money. More, meaning we had a debt problem before COVID. We have $8 trillion more debt just because of COVID above then, since then. They're like in a very short amount of period. Okay, so the government, so the central banks removed, a third, and they were on task. It was announced and released. The Fed was on a path to remove the 5 trillion. What about the other 5 trillion that the central government did? How do you fix this problem? You raise taxes. Thank you, Zachary. And then what? It's not enough. And pay the debt. Just like the Fed selling its treasuries, right? Remember? Reducing the balance sheet reduction. That's the Fed removing the money it added to the economy. Cool. See, easy peasy. You don't even know they're doing it. They're doing it, they were doing it, I don't know, $10 billion a month. No one even noticed, but every month they were removing 10 billion of their 5 trillion. It's a trickle, I know, but it was consistent, and over a period of time, the money is removed. The government should be doing the same. They added 5 trillion, so take out 1 trillion by raising taxes, and then take 100% of that 1 trillion and pay down the federal debt. Okay? And that's another way of removing the fake money from the economy. Yes, it would slow the economy down. Yes, right? Yes, unemployment would likely go up, but inflation would go down. Aha. And then the Fed would lower interest rates, spur the economy, and we get back on track. Okay. This is why socialist pig dogs fail in the argument that um, in the general argument of socialism, socialism sounds great, utopian even. But here's the thing, and this is a great example of it. If everybody is equal, I don't mean that way, like monetarily equal, we'll say. And money is free. You can say it differently, like, oh, groceries are free. Groceries just represent money in a different way. Yeah. Everybody has money, whether they work or not, whether they contribute or not, everybody gets money. All groceries are free. The all transportation's free. You can take the subway, you can take the bus, you can take Uber. Uber's free. Utopian. It sounds great. And guess what? Since everything is free, you don't need to work now. Why would you work if everything's free? And what happens is the whole system fails. The 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 government, in particular the stimulus package of $5 trillion, giving everybody, that's what I mean by equally. Everybody gets a stimulus check. But why would you give money to to rich people? That doesn't make sense to me. Well, that's part of the socialist utopian. Well, which will happen, by the way. Everyone does become equal in socialism because money is useless. So what happens is nobody has any money. Then, if you've ever been to a socialist country, it's not true. Go to Eastern Europe, go to Cuba, look at the old Venezuela. What happens? Yeah, 95% of everybody has nothing. They're filthy, stinking poor. But there's an upper class. But they don't need money, they have power. Because there is no money. All they have is power. And all of a sudden, you go from this idealistic utopia to a living hell. And giving money away for free like we did, all it did, think about it. The people that needed it the most got the money. They lost their job because they worked at a Marriott cleaning rooms. They lost their job because business travel died because of COVID. Okay, cool. They need some help, right? And we actually saw this. You have to remember 90% of America did not lose their job. So in reality, it was actually a small amount of people that needed help. But 100% of people, or nearly 100% of people, got money. That's weird, isn't it? Wait, you didn't even need 5 trillion. Because unemployment only went to 10%. That means 90% of people with jobs had jobs. Why? They had higher skilled jobs than making beds. All right. So help those folks out. But we pumped all this money in, and inflation went through the roof and will not come back because it's right. The government added money, not the central bank. And the only way to fix it is to remove that money. The only way for the government to remove the money is taxation. The only way for the Fed to remove the money is sell bonds. They're straightforward, unambiguous tools to fix the problem. So if we did this, can you imagine prices dropping by 30%? There would be some losers to this. Not everybody's going to win, but I'll tell you, billionaires will lose $50 billion, but probably still have $50 billion in the bank. So, like, can Elon Musk live on only 50 billion instead of 150 billion? What about Jeff Bezos? His net worth of 100 billion will drop to only 45 billion. How's he gonna do? Wouldn't even notice the difference, right? Yeah. But mortgages, maybe, but there's going to be a repricing, and that's because prices went up. Because there was more money. We created demand from nothing. Okay. So imagine, I don't know, what's a good example? I don't know, anything. Printers. Okay. Printers. For your home office. Suddenly everybody needs a home office. And everybody gets thousands of dollars for free. You're like, well, I guess I'm going to build a home office. Makes sense, right? Everybody, all at the same time, need a desk, need a printer, need a home computer or a laptop, need a lamp, need a little trash can. And guess what? All those assets, all those products doubled in price. Because we didn't have, first of all, everybody all got the money all at the same time. So it was free. The price didn't even matter. Well, you got your money for free, and there's a shortage of all of this stuff. Prices went up because of the shortage, and you're like, I don't care. I got this money for free. No, you did not. You have 30% inflation, and you are poor because of it. I hope you like your printer. Let me say it again to be clear. The United States is more poor now because of the stimulus package than ever before. And in particular, if you were poor before COVID, you're more poor now. Rich people are fine. Don't worry about them. They have wealth because they have assets. Right? So middle tier workers, whatever you would say, middle class workers, work from home, and now they have a home office and a 5-year-old laptop and a 5-year-old printer. It's all been depreciated to, nearly zero. Probably these things are probably breaking. If you bought an iPad during COVID, it's probably failing now. You probably cracked the screen, the battery dies. There's been 9 upgrades, and you want the red one, not the white one. Everybody's got the white one. I want the blue one, whatever. You have your needs. And it's depreciated to near zero, right? So that money is gone. It is no longer productive. Wealthy people have no money, but they have converted their money into assets. The real word for asset is of something that increases in value or produces an income. Isn't that cool? Felipe says, I wonder how no one advised against it. I believe Warsh did. He was also a big part of the Fed during the 2007 2008 financial crisis, in which quantitative easing, which was the central bank buying treasuries. Right now, we have the Treasury, the central government buying treasuries. Well, back in 2007 2008, the central bank was buying treasuries, and Warsh warned that this would be a problem. But it's less of a problem if the Fed can add things to its balance sheet during a crisis and then later on slowly sell them so that you get back to where you were, a balanced balance sheet. Okay? When you buy treasuries when the economy is collapsing, you slowly sell them as it's recovering. The problem is central banks should do this, but they don't all do a good job of this. Like the Fed's not doing it now, but they were doing it. So they were on track. Now they're not. Maybe that we bring it back. The government also should know what to do. So I talked about socialist pig dogs, where they're like, hey, let's build a utopia where everything's free. Well, guess what? It fails. It fails monetarily. It fails on a human level. Hey, if everything's free, why work? So all of a sudden, you're free Uber. Nobody wants to drive anymore. Why would you want to be an Uber driver if nobody's going to pay you? But you have to pay for your car, you have to pay for gas, you have to pay for maintenance, you have to pay for insurance. Like, but I don't make any money. I drive around people for free. Well, Uber drivers go away. New York City is going to, and I can't wait to see what happens, by the way. But New York City is moving toward socialism and self-declared. And so there will be in each borough a grocery store in which prices are artificially lowered by like 30%. So imagine if you can go to one grocery store and you can buy a bag of coffee, not for $10, but for $7. What's going to happen? First of all, how do you feel if you're the coffee producer? You're like, ooh, that's more than our entire profit margin. So then the producer, the people that actually package it up and put it in the bags and get it to the grocery store, well, they have to get it from somewhere, and it's shipped from somewhere, like Colombia. So now you got to go to like the shipping company and like, dude, our revenues just dropped by 30%. You need to drop your fees of shipping by 30%. And they're like, oh my God, well, we got to cover fuel costs and insurance. Oh my God. And then, so then you got to go to Colombia and you're like, hey, everybody, we need to pay you 30% less. Okay, there's that. And it's not always feasible. But maybe you're like, well, Wayne, that all sounds like a good thing. Okay. Because if there's less money and everybody drops 30%, then prices are going to drop 30%, but the need for money drops by 30%. And then, well, then nothing's happened. But we can go further. Kate's got one. You can arbitrage the thing, of course, and we call that a black market. Go to a poor country. How often do they have a black market? 100% of the time. Now, why, Kate, does that happen? Because what happens is you go to the place that sells the coffee for $7 and there is no coffee. Oh, it's cheap, but there ain't none. All of a sudden, you're like in Cuba and you get a little coupon book and you go to the grocery store and you can have as much as you want as long as it's rice and beans. So I'm sitting at a fancy place in Cuba, like 1 or 2 blocks from the ocean. This is a fancy pants place. Like a Cuban could never eat there. Amanda's like, you shouldn't have been there. You should have been there. Dude, I didn't know where else to go. Like, honestly, I think it was the first restaurant I ate in Cuba. I'm like, I didn't know where else to go. And the taxi guy suggested it because that's where tourists go. And I'm clearly a tourist. So I'm like, and I get here and I'm like, I don't like this place. It's like eating in America. But anyways, I'm there. And I'm like, ooh, I want the octopus. Yeah, I'm in Cuba. I'm right next to the ocean. So I'm like, I'll have the octopus. And oh, there's no octopus. Oh. Well, I will have the mahi mahi. There's no mahi mahi. I will have right, whatever it was, more seafood. Right, I'm on an island in the ocean, like up 2 blocks. I can smell it in the evening air. And he's like, no, we don't have that either. And I'm like, whoa, 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 whoa. What do you got on this menu? Pork. I'm like, okay. So I get the pork and but then, and he brings me my drink and everything. And then when he comes back to the drink, I'm like, all right, look, I just got here, man. Why don't you have any seafood? And he's like, there's no diesel fuel for the fishermen to take their boats out. But it's cheap. So look, go to a socialist country. You're going to have a black market because the system itself doesn't work and the people know it doesn't work. So they create a side market, a secondary market, because the primary market fails. So it seems to me the experiment that New York City is going to do is it's going to fail, but I can't wait to see what happens. But you get a secondary market. So the person that actually goes out and gets, and I saw people like, you can get the octopus just by fishing near the rocks along the beautiful wall there. But the primary market fails. But it is true, the official system, everything is cheap. Yeah, and made a 1 pound of rice and 1 pound of beans. That's not a lot. Right? No, I don't know what I said, Maida, but yeah, I understand that. It's like the promise is everything is affordable for everyone. Everyone's going to be taken care of and it's going to be controlled by the government. So just come along, go to the grocery store. You got a book of stuff. And there might have been a time on the first day after the revolution, maybe those grocery stores had food. But over time, what happens is you can have anything you want as long as it's rice and beans. And even that is not going to be enough. And because it just simply leads to the inevitable outcome, like using the coffee is an example, 30% cheaper at this store versus all other stores is going to lead economically, mathematically, to a shortage. And what happens to prices when there's a shortage? So this is very similar, and the reason we're talking about this is adding money for free is the same as making everything cheap. So everybody gets money, and it guarantees that you end up in poverty. It doesn't matter. Lower the price or increase the amount of money. Doesn't matter. Everybody's got money. Or you don't need money because prices are low. You don't need money. Or prices are high, but everybody's got money. Okay, but it always leads to poverty. Absolute guaranteed failure. And if you understand economics and mathematics combined, it fails. It's a guaranteed, when you do economics, undergrad economics, one of the things you do is rent control. 100% guaranteed logic, mathematically guaranteed that you will end up with a worst case scenario of nobody can afford housing because you made housing affordable. What should work is capitalism and economics. Capitalism around the idea of free markets, economics around equilibrium. Okay? Because what's the solution to affordable housing? You want to live in New York City. What's the solution? Force the rent down, socialism, or incentivize capitalist real estate developers to build more housing. And you could do it through, let's say, lowering the taxes or increasing some sort of benefit. Like an example of New York City, Trump's first building, that hotel over in that, that hotel over in that place with the, where you go under, whatever you call that. Is it next to Grand Central Terminal? Anyways, it was an old hotel in a bad part of Manhattan. And in fact, that whole neighborhood in the late 70s, I think it would have been, was terrible. Most of the stores were boarded up. There was crime. Tourists didn't go there. New Yorkers didn't go in that part of the neighborhood. It was dangerous. And Trump fought to put in a beautiful modern hotel. Now, he kind of cheated in a good way, and that's what capitalists do, because instead of knocking the old hotel down and building a new one, he just put glass on the outside so it looked brand new. Of course, they did the interior, but he fought and fought and fought and fought and fought and fought and fought with the mayor, with the governor. It went on for years. Meanwhile, he's a young guy. Nobody even knows who Trump is. But he fought, who was it? Ed Koch and everybody. Again, with the mayor and the governor. And so anyways, and eventually he negotiates, and it took years, negotiates this incredible thing where he takes this pretty much useless neighborhood with a useless building and everything is bad. And somehow he finally negotiates something like 15 years deferred taxes. because he's putting all this money in where no one would put money in. Yeah. And over time, guess what happened? The neighborhood came back and was revitalized. And suddenly it was a cool place to be. New businesses, new restaurants, tourists went there, right? And in a way, gentrified. I don't think that's the right word, but whatever. Revitalized. And it was through, eventually, he got the incentive to do it because he couldn't afford to do it unless they deferred taxes. But they're like, hey, you can do it, but the taxes are going to be crazy high because this is New York City. And back then it was very socialist. And so they're like, yeah, high taxes because everything's free. So we got to tax everything high. And so, anyways, he finally got this, and the neighborhood came back. That's how capitalism works. When you get to rents are unaffordable, you have two choices. The government can force the rent or cap the rent. But then what happens is, well, because it's such an expensive proposition and a risky proposition to, I don't know, spend $100 million on a building that you have to depreciate over 30 years, that's a lot of risk and a lot of money. And if you can't make it work on paper mathematically, and this is finance, your cost minus your expenses and your depreciation and your taxes and your insurance and how much rent you can collect, income. All of a sudden, if there isn't enough to compensate you for the risk, or even not enough profit to even break even, you're just not going to do the project. You're not going to build another apartment building in New York City that's going to have 1,000 people live in it. You're just not going to build it because it's not profitable. You just can't. You're just like, well, I can't do it because of rent control. Now, capitalism with economics says incentivize, if that's the problem, incentivize the developers to develop. Make it so worthwhile, so financially awesome for the developer, they can knock down old buildings and put in new buildings. And an old building with, let's say, mediocre living conditions for 100 people could suddenly have a building with awesome conditions for 1,000 people. And then what happens is so much development goes on. You have all these jobs, and all these people need to live somewhere. They need to eat somewhere. They need to, okay. So all of this is putting money into the economy, which is benefiting other people. But what does capitalism do? Boom and bust, boom and bust. So you get to the point where suddenly all these projects are coming online all the same time. So over, let's say, a 5-year period, they all start building projects, but they all take 3 years to complete. So suddenly the first amount of buildings are coming online and they fill up quickly. And then the second set come online and they fill up, but fill up slowly. And then the last set, they all come online, meaning they all finish their 3-year window of building the skyscraper, and the market's saturated. There's more apartments than there are people that need to live in these apartments. What happens to the price? It falls. Who loses money? The developers that were too slow, they were late. The dumb money jumped in because they saw the first crew sell everything at high prices. And they're like, oh my God. Well, that's 3 years after the fact. So then they go through their money raising process and their design, and they find their land, and they find their opportunity. Another year's gone by. And so 4 or 5 years after the fact, they start their project. So by the time their project's done, they're 8 years after the boom, which means they finish their project at a bust. So the losers lose money, perfectly acceptable in capitalism. And what happens to the apartment prices in New York City when the market is saturated and there's 3 apartments available for every one person looking for an apartment, prices come down. Hmm. Aha. Interesting, right? So giving money away for free or artificially pushing prices down through rent control, or in this case, food control, it's all very, very bad. It sounds good if you don't know what you're doing. The solution is what for all of this? Increase GDP. Right? Increase GDP, productivity. More products, more services, more food. The more you increase GDP, the less you need money. You're like, but when we just talked about this other thing, the artificial creation of a less need of money by artificially forcing prices down, by forcing people to accept less, ends up with people earning less. And without the incentive to earn, productivity goes to zero. Instead, you're incentivized to produce. So, twice as much food, twice as much apartments, twice as many Uber drivers. Twice as many desks, twice as many laptops, twice as many watches, twice as many everything. Prices come down 30%. Right? Prices come down 30%. Because everyone is contributing to the economy, increasing the productivity, and lowering the cost per unit, the marginal cost. So twice as many apartment buildings, and let's say, and the apartment buildings have twice as much. So you have 400% more apartments. Guess what? Prices will come down. And it even incentivizes the developers to be smart about it. See ahead of the curve, start producing before all your other developer competitors, and you'll be rewarded by making smarter decisions. The ones that make poorer decisions, that are producing apartment buildings when they're unneeded because they're backward looking, not forward looking, those will be disincentivized. They will lose money and the government won't bail them out. You're like, well, you took a risk and it wasn't a good one. Okay. Capitalism would say, oh, a bad bank failed. You can't be too big to fail. If you're a bad bank that's big should fail. Tell all the other banks. That they're bad. Keep them in line. Dan says, Wayne, you mentioned that the Fed is doing something that is unprecedented in your trading career a couple of days ago. What is that? It was not the Fed, the Treasury. So in 2007, 2008, whatever the exact year was, during that great financial crisis, The Fed borrowed a new strategy that was invented by the Bank of Japan called quantitative easing. And the central bank started buying treasuries from the secondary market. Okay. What I said 2 days ago is that when Secretary of the Treasury Scott Bessent started buying the 20 and 30-year treasuries from the secondary market, I'd never seen that before. Not the central bank, the central government. Okay. The Treasury. The Treasury does a lot of things. Yeah. But buying bonds is not a normal thing. Preventing financial crime, yeah. FinCEN does that. The Treasury has manages the IRS, the Internal Revenue Service. Because what does the Treasury do? Income and outcome, right? Income and outflow. So yeah, they manage the IRS. They manage the SEC, who then manages others, right? There's many layers to government. So anyway, so you got to separate. Okay, you got to separate the central bank from the central government. Okay, so it's weird for the Treasury to buy treasuries. You guys ready for the Jackson Hole speech? Everything is flat. You see this? Flat, flat, flat. The moves look extraordinary because it's jumping from 1.4 to 2.0. And you're like, whoa, that's an extraordinary change from, well, $0 to $1 is a huge change. But $1 to $1,000 is not. So everything is flat going into this. Okay. Metals are doing well. I spent, I don't know, half an hour yesterday in the afternoon session for those who have leveled up on the platform. I spent about a half an hour specifically going through metals and metal charts, not just talking about them, but doing the analysis and all that kind of stuff. And they're all up. You're welcome. Good. Metals or sorry, crypto's interesting. They're not down by that much, but especially relative to recently, but based on, reading the table and counting the cards, that is an interesting clue. Again, if you want more of that type of content, you need to go to the platform and sign up and level up. So yesterday we talked about how hedge funds would set up a pump and dump. And you're like, what's a pump and dump? Well, if you had your own forward guidance based on analytics, So I'll just move over to maybe here. Okay. And you were doing research and analysis. Okay. Based on whatever you want. Okay. The, the footsie. That's not a very good one. Incomplete. Okay. You were studying the DAX. You would have an opinion about the future. And do you know what the future is? No. But would you like to have 20 years of data? Weekly data, not annual data, weekly data. Very refined. And then you break it down, the exponential moving average of the 20-year average, the 20-year average, the 10-year average, the 5-year average, long-term versus shorter term, pre-COVID versus post-COVID, whatever. So you got the data, you have the research, and now you've formed an opinion. This is important because there's no other way to succeed. You'll never be a professional, and you'll never be that next level until you're able to do this. Just trust me, I'm not knocking anybody down. You need to know this stuff. And then you'll be able to interpret what you see. This is incredibly important. So if today ends up with red candles, or if tomorrow ends up with red candles, or by the time we get to Friday of next week, there's red candles. Do you know that I will see those red candles differently than other red candles? None of this is just I don't know how to say it. You have to be able to put weight on what you are seeing on the charts. Where are my charts? Let me get those going again. Red candles today may not be the same as red candles tomorrow, red candles last week, red candles last month. Do you see that vertical line? So I covered this yesterday. Again, visit the platform and join. Do you know what it takes to join the platform? An email address. Do I put you into a sales funnel? No. Like, dude, I have to convince you this data is amazing? Really? I have to send you 15 emails to get you excited? Why? I'm not going to put you in a sales funnel. Okay. But what I'm saying is, because I covered this yesterday, so I'm not going to cover it again. That makes no sense. But what I'm trying to say is you have to have context. And with context, you assign importance. Let me see if I can get examples here. Okay. These red candles versus these red candles versus these red candles. Are they all the same? They're just red candles? None of them have really made lower lows. No, they are radically different. This, for example, I would be on red alert for a lower low, lower high scenario, right? Because this is my profit zone where I believe institutional investors are highly incentivized to take profit and run. Maybe not forever, but it matters. Then I zoom out a little bit. All right. What if, okay, we get red candles up here? Okay. Is it the same as these red candles? This red candle? What about this one? Would you agree that this would carry more weight than the others? By the way, I have no idea why one or two people respond to my questions. If you're really here to learn, you would answer the question. If you're at Harvard, in a class at Harvard, and you didn't respond to the professor, you would fail. Because it's not that the professor doesn't like you, and he won't, or she won't like you, but the thing is, you're not going to learn. Take the risk, type the response. Come on, bro, you can do it. Don't be afraid. Don't be shy. Get in there. Okay, now you might say this as a double top, right? Yeah, double top. The other thing I want to point out is at the beginning of the year, this was our buy. Our second buy was here. So the first one worked, and you're like, but this is this is before January. Yeah, well, we front run. Sorry. The second thing is the conservative target is here, but because of this entry, this is our target. So again, if you don't know how to trade, none of this matters. You have to understand, and we did this 1, 2, 3, 4, 5, 6 months in advance. That is going to have a high probability of being the top of the market for 2026. Now, if you don't understand that, then you don't understand this. That might be your problem. The second thing is you say this is a double top. Okay, yeah. And we all know double tops are potential opportunities for bears, right? Oh, but it's more than that. It's more than that. What if we were not double topping? And why was this important more than all the others? Because statistically, because we're counting cards, that's the highest probability for September. I don't know if it's going to happen. It may not happen. It usually does. High probability, but it doesn't mean it will. I don't know what's going to happen. But the fact that I know the probability is high changes the way I play the game. And then I interpret, okay, a double top right on a reversal schedule. So again, I covered this last night, so I'll make one more point, and then we got to go find the Warsh speech of Jackson Hole. But this is our conservative projected top for this asset that we had 3 months earlier. Conservative. Do you know what these two vertical lines are? The period in which we had statistics that said the probability of down is high. And it did fall. And do you know what this is? The probability of up is high. We knew weeks before. I talked about it almost every day. No, I'd say every day. Every day. It's falling. I know I'm a bull. It's falling. I know. Somewhere between the, the third week of March and the first week of April, I'm a buyer. I'm going to buy. I'm going to buy. And it took off the first friggin' day of April. Yeah, man. Dude, so if this turns red, okay, as we approach this vertical line on an hourly basis, right? As we emerge closer and closer, I have two lines that I care about: the price line and the timeline. And so if we go over the next few days, do I know how to read that? Do I know how to interpret that? Do I know how to put weight of importance? Should I care? Is it noise? Should I buy a dip? And it's an uptrend, bro. Obviously, it's an uptrend. I'm not going to buy the dip. In fact, I'm probably going to hedge the heck out of that move or sell it, which is the version of hedging, right? Isn't that cool? Or you just trade blind. Go ahead and trade your euro dollar every day. Go ahead. Go ahead, girl. Go ahead. Get down. Go ahead, girl. Go ahead. Get down. Yeah. So I hope you're loving it. This is the way to handle it. He's not going to say anything, but I'm already ready. The thing is to be watching. Yeah, Felipe, it's not 1 minute, it's 33 seconds. I'm watching the market. I'm watching institutional investors. I'm already looking into September. I'm already looking into October. Like this meeting, great. It's probably going to be a catalyst. Great. I'm ready, dude. I'm prepared. I've been prepared for a long time. This is great. Bring it on. I'm going to crush it. Nah, don't be sorry, dude. All right. Just pointing out that YouTube is actually slow. There's a lag. I see what you're seeing. Shows you that there is a 1 minute lag or a 30-second lag at least on the YouTube coverage. So let me get to it. Let me share with you. Hang on. Don't freak out. Why are you freaking out? Where did it go? Go ahead, girl. Go ahead. Get down. Hang on. I'll do it again. Ooh, it's not working. Sorry, my pop-up is being blocked, I guess. I have a way to play these things. Minimize the player. And do that. Hang on, I'm trying to get the war speech to pop out. It's saying I need to update my Chrome. Maybe I need to do that. All right. Well, hopefully I don't lose it. No, I can't update Chrome because it'll kill our thing. I'm gonna have to do a drag and drop. Or maybe it's technically not streaming, so I can't pop it. Okay. Yeah, there's a delay. They're late. So Yeah, it's 10:02 and it still hasn't started. So, and I don't think I can pop it till I stream it. Okay. Boop, 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 boop. I mean, I guess I could leave it here, but I like to pop it first. You're like, what are you talking about? Well, you'll see in a second. So I think I'd like to stream real-time price action. And I think we want to watch equities. See what happens to our friend the Nazi. If NASDAQ collapses, right? If the S&P 500 collapses, we go up from up 1% to negative 1%. That would be a sign. Or this is there, it's going to pop, pop, and pop. But remember, pop, pop, and pop might just get us up to targets, and then it collapses on us. Okay. We're going to have to refresh. I'm still waiting. Still waiting. Bum, 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 bum. Look at, dude, the strongest currency right now is up 0.03. Dude, the weakest currency is 0.04 negative. Dude, flat, 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 flat. So we'll see how, right? It shows you how important the central banks are. Nobody's doing nothing. So is it the Associated Press that's behind? I'm going to have to change to see it.
Changed.
Yeah.
We've come to a hinge point in history.
Sorry, that was the
Borrow a phrase,
Associated
a framing
Press.
from my former mentor, George Schultz.
And it did pop.
To cite the clearest example, progress in AI, the 80-year-old name for the newest technology, has been faster even than its evangelists predicted just a couple of years ago. The potential for substantially higher growth is on the rise. Ever-expanding pools
What
of
a terrible
capital
camera person.
pouring into AI-related infrastructure of all sorts.
Zoom in, bro.
A kind of super Moore's law seems to be playing out. Scaling laws, too, are changing both the method and speed of innovation. Capital and labor have combined to create large language models at the heart of AI. Users buy tokens to gain access to these models.
Yeah, I do.
Reports put annualized token sales for the two leading labs alone at more than $100 billion.
Yeah, I'm
an
spending
increase of
money on this.
500% from just 12 months ago. We at the Fed, we watch all this attentively. We recognize that AI is a new variable, potentially a new factor of production that will have consequences both for the economy and for the conduct of monetary policy. It opens up some major lines of inquiry. Will the application of AI cause a significant sustained rise in productivity across the economy? If so, when? Will token usage be complementary or competitive to labor? Will the next generation of AI models demand even greater capital intensity too? Or will the models themselves help devise a capital-light solution? Among the other yet unknowns is the resulting market structure. Who gets to make the money? It's not obvious where the returns on capital will land or on what timescale. Early on, how much of the surplus goes to owners of scarce assets, the AI labs or chip makers or energy producers or cloud providers? Over time, how much of that value accrues to businesses and consumers? And importantly, what are the implications for workers and for the employment side of the Fed's mandate? Likewise, we don't yet know the equilibrium price of the tokens that give access to these models. Might there be a heterogeneity of tokens such that growing sums will be paid for the access to the best models, those at the frontier? Will token prices for older models fall to the level of their marginal cost? Well, we'll be thinking through these matters with the help of a task force on productivity and jobs. My early check-ins with the leaders of that task force and the rest have been very encouraging. To be clear, though, their recommendations will come later and have no bearing on decisions we make in the current policy conjuncture. But I believe that for future policy challenges, this intellectual investment today will leave us much better prepared for tomorrow. Next, let me say a word about forward guidance and its substitutes. As our task forces go about their work, as you might know, I'm not waiting to introduce innovations at the Fed to help make us fit for purpose. To highlight one example, I've set out to change the form and function of the Fed chairman's so-called forward guidance. You might know about my longtime discomfort with early pronouncements of future policy decisions. I much prefer another path, and now we'll make the case for it. Transparency and communication, right. Forward guidance as a regular practice was adopted by my colleagues and me during the global financial crisis. It was essential at the time.
We've talked about this.
And we introduced it with much fanfare. But as with other legacies of crises past, I believe the practice has outstayed its welcome. In normal times, the role of forward guidance should be limited and circumscribed. Otherwise, it risks creating ambiguity in the name of clarity. Oversharing policy deliberations and overcommitting to future decisions can lead markets, businesses, and households astray. And I believe when policymakers make quasi-commitments on interest rates throughout the cycle, we inhibit our own freedom to make the right calls when it's time to decide. To get policy right, we also need to get the relationship right between the central bank and financial markets. The Fed needs clear market signals, as unfiltered as possible, from market internals, from the level and change in asset prices across sectors, the prices and trading volumes of Treasury securities, the foreign exchange value of the dollar, the cost and availability of credit, a broad set of commodity prices. These and other indicators should inform the Fed's near-term outlook on economic activity and inflation throughout the business cycle. They should also reveal the state of broader financial conditions and the risks and uncertainties of the financial cycle. At the same time, market participants themselves should be tracking real information about the real economy.
Gains.
They should draw their own conclusions, form their own expectations on things like output and employment and inflation, and they too should stay sharply attuned to risks. In my view, the Fed should be humble and never naive. The Fed plays an essential role in the economy and markets. Our tools are powerful. We determine the path of short-term interest rates, and market participants will always try to anticipate what we will do next. But we should not indulge a regime in which market participants are looking primarily to the Fed for their next trade. The economic literature has long described the distorting effects, what it called the Hall of Mirrors problem. If markets rely materially on the Fed's guidance and the Fed relies on market prices, we're more likely to be blinded to new developments, more likely to be caught unprepared, and more likely to commit errors in policymaking. Now, perversely, market participants are unlikely to bear the biggest costs of the Hall of Mirrors problem. The most serious harm is likely to befall those without any financial assets. If the Fed gets inflation wrong and judges the economy wrong, who gets the worst of it? Not the financial high flyers. Hardworking Americans are the ones left to deal with inflation that's too high or jobs that suddenly appear less secure. So, if forward guidance is ill-suited to normal times, how about the new Fed chief commits at a meeting just like this to some explicit reaction function? Surely he could tell us his interest rate path if, say, the data were to come in hot or cold. Well, I wish our understanding of the economy were so precise as to provide a mechanical, tried and true
Check this
answer.
out, too.
That some simple function, like a Taylor rule, could be rigorously relied upon. But our knowledge just does not extend that far, at least
Look at
not
that.
yet.
159.
And other factors, most
80.
relevant to the proper conduct of monetary policy, they change over time. Providing forecasts to illustrate the Fed's reaction function works better in theory than in practice, better in the lab than in the field. I am not alone in noticing that forward guidance in 2021, to cite just one example, might well have slowed the policy response to high inflation. In my term as chairman, my colleagues and I will endeavor to construct more reliable models, more robust rules, and we'll do this knowing that accuracy in forecasting is still just an aspiration. With so much changing so fast in our geopolitics, global supply chains, technology, it's wise to be modest about what we can and cannot know as we sit here today. In the same spirit, we should receive the full range of ideas on matters that may inform the Fed's monetary policy discussions. If the aim is optimal decision making, and it should be, we should not crowd out views on the economy. How then to chart a better path to policy? In the balance of my remarks, I will share with you some key principles that guide my thinking on the appropriate conduct of monetary policy, and then I'll offer my promised assessment of the economy.
Yay.
So let's turn first to principles. First, I've noticed in this line of work, yesterday's news has a way of getting mistaken for what's happening right now.
Yeah.
The challenge is to know the difference. In other words, we must interrogate reality. Make sure we're not setting forward-looking policy based on stale or inaccurate data. Nor should we rely on isolated data points. Trends matter most. The Fed's a decision-making agency. We make choices amid uncertainty, and the data upon which we draw must be relevant, contemporaneous, accurate, and as actionable as possible. Second principle.
87.
The Fed's actions are intended to ensure that the aggregate
88.
demand side of the economy is broadly consistent with aggregate supply.
Watch the 160.
However, all we observe directly is activity. We never see and can only infer what's really happening on the supply side. Hence, evaluating the current and expected balance between aggregate
collapsed.
supply and aggregate demand is
Telling you.
imprecise. Third principle, there should be no misunderstanding. The Fed's price stability objective of 2%, as measured by the PCE price index, is a firm, fixed target. Let me be equally clear about another aspect of this objective. Price stability is not self-executing, nor is inflation necessarily mean reverting. It's the Fed's job to deliver stable prices, no excuses. Fourth principle, the Fed also bears responsibility for maximum employment. Achieving both sides of our mandate over the medium term is not an either-or proposition. I do not believe the Fed's dual mandate works at cross purposes. After all, high inflation itself is very harmful to economic prosperity. Fifth principle, short-term interest rates are the predominant tool to achieve the dual mandate. Unconventional policies to spur economic activity may suit genuine crises, of which we all have much experience, but they should otherwise be used sparingly, if at all. Sixth, money matters. I know it's not fashionable these days, but my view is that money has something important to do with monetary policy. We should pay attention to money created by the central bank and money that comes from the banking and financial system. It's true that financial innovations, the subject of this conference, and other factors alter the mechanics that link the monetary base, the velocity of money, and the broader economy. But that is scarcely a reason to ignore the ultimate effects of money on financial conditions and prices.
Sounds like
Finally, a quieter Fed, a more purposeful Fed in its communications, is better able to meet its objectives. And we can be held accountable for delivering on our remit, the only true test of our credibility. To borrow a line from General Chuck Yeager, at the moment of truth, there are either reasons or results. So having heard a little bit about AI and general purpose technologies, having heard a little bit about the next policy conjuncture, a little bit on principles, let's turn to the economy today. Given those principles, how do I read the economy? What's really going on outside the window? It's a little ironic. There are no windows in this room, but there are big ones at the Federal Reserve. And we've been using those in my first 100 days, and I expect we're going to continue to use those in the period right ahead of us. Now, you may have read in the July minutes the unanimous view of the FOMC. Labor markets were stable, output solid, but inflation remained too high. A good majority of my colleagues and I thought the wiser course was to await new information in the intermeeting period, especially given possible developments in supply chains, investment flows, and geopolitics, before deciding whether a change in interest rate policy was advisable. And we expressed our joint readiness to act as circumstances require. For my part today, as we sit here, I'm impressed by the overall performance of the economy, which appears to have strengthened. One indicator of strength is how well an economy holds up under stress, how well it holds up under shocks. On that score, both Main Street and Wall Street have been remarkably resilient. Several other observations. Business CapEx is rising rapidly. The 4-quarter change in investment in equipment and intangibles has been around 9%, its highest growth rate since 2021. And more than half of the CapEx growth can likely be ascribed to the build-out related to AI. What about profits? For the firms in the S&P, profits have grown more than 20% over the past year alone. Profit margins are quite elevated relative to history. Overall equity and market volatility, quite low. We're staying keenly focused on market internals, watching performance across sectors. Expectations for both growth in CapEx and corporate earnings are running quite high. I continue to watch the change in the growth rates, the second derivative. The follow-on effects on asset prices, business confidence, consumer incomes and spending are equally important to gauge. Credit spreads on corporate bonds and leveraged loans are near the low end of their historical averages, and issue volumes this year quite strong. Looking beyond fixed income markets to the banking business, in the July so-called SLOOS survey, banks tell us that standards for C&I loans are on the easier end of their historical ranges. That helps explain their growth that we've seen this year in these loans. In my view, credit and loan markets are showing few signs of policy restraint. Now, certain sectors, like housing and agriculture, are showing strains. But on balance, I would be hard-pressed to describe broad financial conditions as restrictive. Real consumer spending has been healthy despite these shocks, increasing more than 2% over the past 4 quarters. If you combine consumption with the brisk investment we talked about earlier, private domestic financial purchases have also risen. These purchases have increased at a pace of nearly 3% or so far this year. That's a measure that typically carries more signal than GDP. The trend here, too, positive. So on the employment side of the Fed's dual
This
mandate,
is it, the moment
country's
of
doing
truth.
well. Labor markets are quite stable. The jobless rate at 4.1% remains low by historical standards and hasn't changed much in a couple of years. Unemployment claims on a 4-week moving average, an empirically robust real-time indicator, are near their lowest level in decades. In my view, the relatively low turnover in today's labor market is partly a result of the significant rematching between employers and employees that happened in the post-pandemic environment. But when labor supply is barely growing, monthly job gains are naturally going to run low. There are always areas of concerns in the labor market. For example, among recent graduates. In general, though, people who want to work, by and large, are holding or finding jobs. They may well be concerned about future labor disruptions, but as of now, I believe the labor markets are broadly consistent with full employment. But on the price stability side of our mandate, the numbers are more concerning. The Fed's preferred measure of inflation, the one I talked about earlier, the 12-month change in the PC price index stands at 3.7%.
Dude, there you
The
go, man.
6-month change,
Dude.
a little above 4. The comparable measures from the CPI index are also elevated, as are core measures both of PCE and CPI inflation. And none of these measures are perfect, but they all tell a similar story. Inflation is running above our 2% target. So the Fed's predominant focus right now should be on prices. So what's our job? The job for policymakers is to capture underlying trend inflation.
Dude.
Easier said than done. We want to gauge whether underlying inflation is rising, falling, or seems to be stuck in place. We also want to understand not just the direction of travel, but the speed. Each of these broad inflation measures have fallen significantly from their highs of a few years ago, but progress over the last couple of years has been more modest. And while this summer's PCE and CPI readings were better than expected, they do not tell me that underlying trends have meaningfully improved. The data also show moderate wage growth, but in my view, in tracking underlying inflation, wage growth has not proven a reliable indicator of future inflation for a very long time. So to try to gauge underlying inflation, I want to tell you about a couple things I've always looked to. I find it instructive to disaggregate the 199 individual components of the PC price measure. Over the last 12 months, 54% of goods and services in this basket showed price increases above 3%. This is well below the post-pandemic highs of about 77%, but it remains well above the level of 32 in a couple of the decades that preceded the pandemic. Looking over just the last 6 months, the conclusion is similar. 49% of goods and services in the PC basket showed price increases above 3%. Again, this is well below the post-pandemic highs, but still elevated, quite elevated. The recent rise in overall commodity prices also bears watching. What we need to judge is whether the trends we see indicate upside inflation risks. Now, it matters, too, whether the inflation readings of the past 5 years have seeped into expectations. The good news is that measures of inflation expectations in the medium term, by and large, look stable. And inflation compensation measures from the swaps market send a strong and similar message. Especially in light of recent developments, it's a credit to the Fed as an institution, consistent with the best of the Fed's traditions, that market prices show confidence that we will deliver price stability. And I can assure you, they're right. The thing about market measures of inflation expectations in economic history, I know some economic historians in the audience, is they all tend to look really strong and durable until they don't. These expectations are not pushed around easily, and right now they are very well anchored. But they must be closely minded, and it's the Fed's job to make sure that inflation expectations do not get unanchored. Now, there is one signal nobody can miss. The responsibility for 65 months of sustained elevated inflation sits squarely with the central bank, and that's where it belongs. So here is my standard. We must be confident that underlying inflation is moving to our objective, clearly and at sufficient speed. Otherwise, we have work to do. That's our job, that's our mandate, and that's our charge to keep. So I've covered quite a bit of ground in the last 25 minutes or so. Let me see if I can conclude this way. I stand here today committed to a discipline, not a decision. My Fed colleagues and I are hardly the first to hold these positions in a time of great consequence. We are determined to redeem the time by doing our very best work. For those of you that know us, you'll know the following is true. We take our responsibility seriously, with humility and with resolve. We know so much depends on the choices we make. Sound monetary policy helps households and businesses to prosper. When carried out effectively, it broadens and deepens the momentum of our economy and helps to secure America's leadership in the world. And I know that our country needs us to think carefully and act wisely, perhaps now more than ever. It's a tremendous honor to serve once again at the Federal Reserve. I'm truly grateful for the encouragement, good counsel, and the warm reception I've received in my first 100 days from my colleagues. I'm also honored and grateful for the views that I've gotten, solicited and unsolicited, from so many of you in this room. For that, and for your kind attention this morning, I say thank you. Let's get on with the rest of the program.
Thank you very much, Kevin, for getting the conversation going. Could our first set of panelists come up to the stage? So Kevin, thank you.
All right, there you go. That was cool. So we got our catalyst. What will happen next? Well, you have the data. You have me doing hours and hours and hours of speeches. You have 20 years of data. You should have already done all the work. Telling you. So now we're here. What are you going to do? Do you have a plan? for the next 5 weeks. What will happen next week? Well, we're going to find out. And NFP is late next week. And then there's I think there's a holiday the next Monday. And all of a sudden, you're going to find yourself September 10th, 1/3 of the way in September. And did September just start today? Could be a rabbit, could be. You do you. Peace on earth. May the pips be with you. May your profits be above average. Cheers.